Earnings report for Q4 2020 came out yesterday. I want to discuss the main takeaways that we took from this call and how we're thinking about Tesla going forward. This is the Not Even Wrong podcast. It's January 28, 2021. This is Krim Delko. Since the last update on January 25th, we're down 6.5%. The market's down roughly 1%. For the year, we're up 20.5%. The market's up roughly 1.5%. We're outperforming by 19%. So Tesla came out with the numbers and the report and the shareholder letter, and I think I want to take out some of the main takeaways. So first of all, they came in soft on automotive gross margin, about 300 basis points. I think this is the main concern also. That's why the stock is down after hours and also today in trading. I think other key takeaways are the launch of the Model S Plaid and the Model X Plaid. I think that's very good news. I'll talk about that. We had some conversations about AI, about the valuation of the company. Overall, Elon Musk was very bullish on the company and also on the prospects of the stock, which is a little bit unusual. I want to talk about that also. So let's talk about the numbers first. Automotive gross margin comes in at roughly 20%. 300 basis points below expectations. Here's why this is disappointing. Tesla had a record quarter of deliveries. They delivered 180,000 cars. So we were hoping that with this large volume, the gross margin would also get a kick, because the more volume you have, the more you amortize your fixed cost. Tesla is a fixed cost business. It's a large factory, gigafactory manufacturing business. So the more volume you have, the more you can amortize your cost, and therefore your cost of goods sold relative to the sales come down and your margins go up. This didn't happen. Zuckerkorn said two reasons for that. Number one was large costs in terms of ramping up production, bringing up large stamps, for example, for the Model Y production, things like that. Some of that, of course, is CapEx and shouldn't affect the P&L of the quarter. And some of that, I guess, was expensed as P&L. Then the other reason is also pandemic-related supply chain issues, which I think is understandable. So overall, those were the issues that he mentioned. He said adjusted for those issues, our gross margin actually would have been up. So what the key message that Tesla's sending here is that it's not because we're lowering prices. ASPs have come down 11% year over year. That is not the reason why our margins are not growing with volume, and we expect the operating profit to keep growing the way it has been growing. This is the message that Tesla is sending out to the street. Our take on that is that, first and foremost, there is no such thing as adjusted earnings. You're a growth company. You have to keep growing and investing. So whatever margin you have, there's no such point as you don't grow anymore and you will not have, let's say, disruption in the supply chain or disruption in logistics. Those are the kinds of things that I think will be reoccurring. On the other hand, I do take their message that they want to increase operating profit and become industry leading at face value. So that is a good thing. However, I feel them comparing themselves as industry leading margins is a little bit kind of, how should I say, it's not the right way to talk, because you really aren't part of this industry. I mean, your valuation is way higher than any of the industry peers. So you shouldn't be comparing yourself to the industry. I think you should be comparing yourself either to nobody. Just say, look, we are a new kind of company that combines hardware and software, or you compare yourself to Silicon Valley, and there your operating margins are still way below the actual margins that people like Apple or Microsoft have. And there's a bit of an inconsistency there also with Elon Musk, because he talks about the potential to value his company at wherever it is now, and he talks about the FSD and the AI, which can be extremely beneficial in terms of profitability. But then he talks about industry-leading margins, comparing himself to an industrial company. So that's a little inconsistency there. Are you a software company? Are your margins comparable to a software company? Or are you an industrial company? And should we think about you as an industrial company? If we think about you as an industrial company, your valuation is not justified. So there is a bit of an inconsistency there. I think that Elon Musk and his team have to have to sort through. So to me, this is a little bit of a negative. But let's talk about the next item here, the cost structure. We've said many times on this podcast, the future of this company is the cost structure. A company fights disruption, fights the threat of disruption, either coming from the Chinese manufacturers or even from the OEMs. The disruption has to be fought through the cost structure. Lowering the cost structure is everything this company needs to do. And therefore, the comments that Drew Barlino gave in terms of where they stand on the battery technology in particular are very important. The comments weren't very new, but that's also, I think, understandable. We've only had about 4 months since the battery day. So he just reiterated all the things that were said on the battery day. And I think in that sense, it's fine. We don't expect a hell of new uh, comments on this front. So I think it is key, though. We should keep an eye on this. The competitive nature of Tesla will always depend on how they are able to adjust the cost structure downwards. The $25,000 car is not just a concept car, it is the answer to the threat of disruption coming from China and coming also from OEMs such as Volkswagen. Musk was talking about the valuation of the company. He actually gave two ways to think about it. One was, in my view, that's the one where he's not very consistent, where he says, well, we could have 50 billion in revenue and we could double that revenue with FSD, and that doubling of revenue would be almost 100% margin. So you could think about us as sort of a $1 trillion company if you take 50 billion in profit times 20. That's one way to think about it. The other way to think about it is to a question from an analyst, where the question was, should we think about Tesla as basically a margin on top of battery production? And he said, yes, that's actually a good way to think about it. So if we take 2030, 2 terawatt of batteries, and then we have a certain margin on top of that, we can then start valuing the company as such. And if we just do the math there, which we did, I don't want to go into details here, but you could come up with, let's say, an EBITDA between 200 and 300 billion, and then you can put between 15 and 20 times EBITDA, so you can have between 5 and 6 trillion in market cap. If you discount this back to today, you get a CAGR of between 12 to 20%, depending on where you stand on the multiple and etc. So what that means in broad strokes is that the company is very highly valued relative to its expected CAGR of 50% volume growth. However, it is still in the realm of possibility to have Tesla become the most valuable company in the world, and most importantly also, the stock price is reflecting the potential. So this is not like a crazy valuation or anything like that. This is, I think, what's important. Now let's talk about competition. I think competition, it didn't come up in the call, very interesting, but I think competition is key. Competition is going to be key going forward. We have competition coming from Germany. We have competition coming from Asia. That's real. Those are not just, I think I don't want to dismiss the competitive threat as just another competitor who thinks, I think particularly Volkswagen under Herbert Diess is very nasty. There's very nasty attacks on Tesla, for example, with PR campaigns such as we're outselling Tesla in Europe, factually wrong. It's kind of like the reverse of Merchants of Doubt. So the Merchants of Doubt, the book and the documentary, shows how the tobacco industry was spreading doubt over the threat of tobacco for cancer. And what Diess is doing is the opposite. He's spreading false hopes around Volkswagen being this industry leader, this OEM that fights back and all these things. So it's, I would say, like again, reverse Merchant of Doubt. I think it's dangerous because people can get hooked on these types of uh, narratives, and they're wrong. Clearly, Volkswagen is not outselling Tesla. Volkswagen is not a better car than Tesla. Volkswagen is nothing compared to Tesla. And we can see that the nasty methods that Herbert Diess is using, Diess is behaving a little bit like my partner Zovinar says. It's a bit like the girl that you met at the bar and had drinks with, and then she starts stalking you and harassing you at home, and that becomes very uncomfortable. That's how he's acting. And I just want to reiterate, we believe at Orange Capital Partners that the mission of Tesla can only be accomplished if Tesla takes all the market share they can get if they kill all the competitors on the way to electrifying transportation, and that there is no room right now for any kind of competition, particularly not from OEMs, from the ICE world. Maybe at some point there will be room, but not now. And that's a whole other episode. Why that is the case, this is our belief. We believe that Elon Musk, rightly so, is very focused on competition. And this leads me to the next point from the call, which is very important, and that is the launch of the Plaid versions of S and X. I think this is much more important than the street is attributing it to, because this Model S and X, first of all, they are important models. If they can produce and sell 100,000, that is a lot of volume, very high margin volume. So first of all, it's very, very accretive to margins. That's one thing. Second, it also creates this new narrative around Tesla of being a luxury brand across the board. So if you buy a Model 3 for $35,000 or a Plaid for $135,000, you are part of a family of very high-end brands. This is what this message is sending. And in particular, the competitive threat between $80,000 and $150,000, so that range hopefully will be covered by S and X now. And we have calculated that there's probably around 1 million cars globally sold in that range. So let's say Maseratis, Mercedeses, and those types of cars. And since the Plaid is the best car in any kind of category, but particularly in that category, so the price value, the upside is so dramatic here that we believe that they have a good chance of getting 10% market share, at least in the beginning. We actually are hoping, this is not in our model, but there is a chance that we could get to more than that. We could get to maybe 20,000, 200,000, 300,000 cars, because this car is really a whole different ball game. This is a very, very high performing, high luxury, high everything car that it could work. I mean, this is the question, and we don't have a clear answer for that right now. We will monitor that, but we wouldn't be surprised if maybe 2 quarters down the road they will up their production capacity to 150,000, because these are high margin cars, and they said on the call that they are constrained by battery, and therefore they want to package every kind of battery into the most high margin product. This is the reason why they're, for example, not increasing the supply of Powerwall, even though Powerwall demand is very high. This is the reason why they're not bringing the Semi yet and the Cybertruck, because, for example, on the Semi, Elon Musk said that we could make the Semi right now, but it takes 5 times more battery than a regular car, and we cannot charge 5 times more money. So there is sort of how can I package this battery cell most optimally to make the most money? And I think Plaid, S and X are the answer to that question. To summarize, I think the main takeaways from the earnings call are the margin soft is a continuing concern, and we have to see how Tesla can get from industrial margins to software margins. This is the key question. Zach Kirkhorn is comparing himself to industrial operating margins, while Elon Musk is talking about software margins. I think this tension needs to be clarified. Which one is it? Are you a software company, or are you an industrial company, or what are you? Or are you something in between? And maybe you are something in between, like Amazon. I think that is the big question that will support the billions and billions of market cap that Tesla has added in the last 12 months, or it will not support it. That's the big question. So the trajectory towards software margins is AI. It's having hardware, a software as a service driven model through hardware. So a little bit mix of software as a service, a la something like Salesforce.com, but then also having, of course, a hardware business like Apple, and in between selling software, in particular the self-drive software. But there's other things that Tesla could do. They mentioned the Dojo, so visual training supercomputer that helps other companies, for example, robotics companies, train on three-dimensional video. So those are the big questions going forward. Other than that, we also have, of course, product questions. like Cybertruck, semi-truck, things like that. I think that's on track. The manufacturing prowess and the ability to manufacture at scale and using Wright's law, so lowering the cost per unit. Those are the big questions that I think are less prevalent right now than they were before. But I think the big question is, are you an industrial margin company or are you going to be a software company with the margins of a software company? Thank you.